Good afternoon, everyone. I'm going to give us all another minute or so. We wait for a few more folks to come in. All right, I think we're at about a quorum. So welcome to today's webinar. My name is Kenneth Megan. I'm the manager of policy here at the Economic Innovation Group. And thank you all for joining us this afternoon. Today's webinar is on engaging investors in opportunity zone deals. I'll be co-hosting today with Rachel Riley of Aces and Archers. And we are very happy to be joined by a great panel of experts, including Emily LeCure of AltCap, David Coons and Will Walker of Hall Venture Partners, and Stacy Cumberbatch of Blended Impact. We look forward to hearing from this great group of practitioners to see how they're engaging in the OZ space. So a few housekeeping items before we get started. We will be sharing a recap of this event, which includes recording and slides on our website. And everybody who's been registered will receive a link at the end of today's webinar. We will also have a Q&A at the end of the presentation. But if you have questions throughout the webinar, feel free to put those in the Q&A function. And please use the Q&A function rather than the chat function, because it's much easier for us to check. And we will try to answer the questions as we go. But we will also have some time at the end to answer the questions. All right, so moving on to our agenda. I'm first going to give you all a few updates on opportunity zones and resources. And then we're going to be talking with the OZ investors on an overview of the investor base, insights into investor behavior, strategies for engaging investors, considerations for investor pitches, and use cases for different OZ investor typologies. So with that, just a few updates on our end. So the IRS issued an announcement on May 14th, which clarified that OZ boundaries will not change in light of the 2020 census. We also have a new blog, Investing in Rural Gateway Communities. It's live. So visit the OZ section of our website for additional resources, including the OZ activity map and investment profiles. And with that, I'm going to kick it over to Rachel Riley, who's going to discuss our latest blog on Ohio's OZ investments. Rachel, take it away.
Yeah, thanks so much, Kenneth, and welcome everyone to another Opportunity Zones webinar. So as Kenneth mentioned, the team at EIG did a really great analysis on what has happened in the state of Ohio regarding OZ activity. And the way that they did this was that they were able to access administrative data from the state of Ohio due to the fact that Ohio has the state tax credit. And we knew that there had been a lot of investment drummed up in the state of Ohio, a lot of investment into communities because of that tax credit. It was a tax credit that was meant to spur local investment and keep investment in the state. And so EIG decided to do this analysis, and we had the data to get it done. So wanted to, first of all, share that analysis is available, but also just share some high-level findings. So at a minimum, 22.5% of the Ohio OZs have received investment. It's about $450 million in equity that has been raised and invested, but that's just in 2020 and 2021 thus far. So you would imagine that there's probably been more investment activity in 2018 and 2019. So that just represents a portion of total investment. The average OZ had a poverty rate that was of 35% and a more diverse population relative to the state as a whole. So really demonstrating that these are high need communities that have received investment, and to also demonstrate the diversity of investments that have happened and the wide breadth of investments that have happened. 350 entities invested in 215 distinct developments and businesses. These are all important, nuanced words. Like there's real activity happening in Ohio is what I'm trying to get across here. And it happened in 72 census tracts or OZs across 18 counties. And so, nope, that was actually a perfect segue because we're going to keep on talking about this Ohio data. So you can go to the next slide. Thanks. So all that to say, that was, some of the high level information from the analysis in Ohio, but the analysis also drilled into what the investor base in Ohio looks like. And so I want to dive into that just given the topic of today, which is, engaging investors in opportunity zones deals. The analysis found that the median investor made an investment around $200,000. And so a lot of times we're hearing that, these opportunity zone investments are millions of dollars, or a question that I get a lot of times is, how small can an opportunity zone investment be? And so when we're looking at, this really great table that was created, and we're looking at the size of investment that occurred in Ohio in 2020 and thus far in 2021, we're seeing that there were a greater number of investors skewing towards the lower end of investment sizes rather than the higher end. And so I just think it's important to point out, like I mentioned, it's kind of like a first of its kind, data driven, as opposed to anecdotal report of what is happening in a state. And just want to applaud EIG for their work on this. And I think it's just really good information to have as we continue the conversation about the investor base in opportunity zones. You can go to the next slide. So while EIG was able to take a look at the state of Ohio, I wanted to bring up again this report that came out in about a few weeks ago, either in April or May. I think it was April, from the Berkeley Opportunity Lab, this neighborhood level investment of U.S. Opportunity Zones program, the early evidence report. And for those not familiar with this report, it was an analysis of anonymized 2019 federal tax records that were filed electronically. So there were a number of records filed by paper. So again, not a comprehensive overview. It only takes a look at 2019. But something that I don't think was really covered in very well in this paper or in the media coverage was the wide range of the household income of investors. So the paper really focused on the fact that QOF investors were towards the higher range when it came to 2019 household income. But if you look at the red bars on this graph, there are a lot of QOF investors that skew towards the lower tier of household income. And so, if you're trying to glean some insights here, the way that I take this is that there are households that are not making $1.5 million annually that are engaged in opportunity zone investing. And then if you pair that against what we see in Ohio, where there are some investments in quite a number of investments happening in lower amounts, that there may actually be a lot of activity occurring from middle income, higher middle income households of low dollar OZ investments. So again, we don't have the data to prove that quite yet, but we're just taking these two pieces and trying to understand what's happening in the investor market. You can go to the next slide. And this is also, there were some graphs that were included in the Opportunity Lab report that I wanted to pull out as well for folks. This first graph is the panel A, this is total quaff investment by state. And so what this really shows is that what you would assume, the more populous states, so like California, Texas, Florida, New York, Illinois, that's where the majority of investment is being raised. And then if you want to go to the next slide, they actually broke it down per capita. Go back to the previous slide if you don't mind. Thank you. Go back, the per capita, you see a little bit of a different trend where you're seeing that the majority of investment is occurring in or being raised in like the Northeast, Pacific Coast part of the nation, as well as in the Mountain West and a little bit of the Great Plains. So think like Colorado, Wyoming, Minnesota, and Nebraska. So all of that information is available in that Berkeley Opportunity Labs report, which I think was just linked in the chat box, but wanted to pull out that high level information for you. Again, as we're talking about who is investing in opportunity zones and what size these investments are and what sorts of households are investing. Go to the next slide. So as promised, we're going to talk about the different typologies of investors in opportunity zones. You know, we've seen local investors come out in a really strong way. There was the Brookville, Indiana report that LISC provided about a year or two ago that demonstrated that local investors were able to drum up a lot of support and make investments in their community. We saw that again at MLK Gateway in Washington, D.C., and also in Montrose, Colorado, where they raised capital from multiple OZ investors, some of which were local investors as well. And so when we're talking local investors, I don't want to forget the high net worth investors as well as family offices. So that's like, you know, one segmentation of the market. And then you think about the VC style firms. We're seeing Corey Innovation Fund continue to invest throughout the nation in rural communities. In Nebraska, there's a really cool project that was being funded by IC Ventures. So talking about more like VC style firms, we'll hear more about that today. We're seeing, of course, Fortune 500 companies investing in their hometown. So these anchor institutions, financial institutions, there's like too many banks to mention right now that have been investing with opportunity zones. So I just threw in this report that has been offered by the Office of the Comptroller of the Currency on how to do opportunity zone investments to strengthen communities. This is geared towards financial institutions, and it provides a number of different examples. And then foundations, a lot of folks are still asking, you know, how can foundations support opportunity zone investments? We just found out in March that RK Mellon Foundation is doing a $20 million investment to support Pittsburgh, Southwestern Pennsylvania. And that we don't know necessarily if that's going to be an opportunity zone investment or if it's going to sit alongside an opportunity zone investment, but we're still seeing foundations are able to play a role in catalyzing this sort of activity and these transactions and attract additional private capital into their communities. So, you know, we have 4 really great guest speakers today from 3 organizations. And I'm not going to take any more time. I'm going to let them share their stories, share their advice, and you can hear it directly from them. So first, I'm going to let Emily talk about the great work she's doing in Kansas City with AltCap, which is a really wonderful organization, a community development financial institution, if I'm not mistaken. And they've done a great job of engaging, especially a foundation locally in the work that they're doing. Emily, I'll hand it over to you.
Thank you, Rachel. So I am Emily LeCure. I'm based in Kansas City, as Rachel said, with AltCap, which is a CDFI here. We formed, when opportunity zones were announced, we went ahead and formed a subsidiary called Equity Squared. And so I'm managing director of Equity Squared alongside being the director of impact investments at AltCap. Next slide, please. So I really like to start with this one simple image when I start talking about both our QOF and our actual firm. Because really, like where we're positioned in the market, it's really unique locally, but also in a kind of broader market. I think a lot of folks are doing something similar, but I like where this positions us specifically with the opportunity zone mindset from impact, right? So on one hand, you have traditional philanthropy, and op zones present this rare opportunity where investors can realize the tax advantages that are traditionally associated with philanthropy. But, unlike in that scenario, they're not giving their money away, right? So that's where it's in between this classic investing kind of strategy and traditional philanthropy. So you're realizing both personal and community benefits. And, both of those may be lesser. It's to varying degrees, like we're balancing, a diversified portfolio, which I'll get into. But alongside balancing that risk and return, we're balancing impact. So some projects, have this outsized impact and others are a bit more modest. But what I always like to share too is that all investments are impact investments, right? Sometimes that impact is negative and sometimes it's positive, and it's a whole range in between, right? So what we're doing with all of our work is, really we're measuring all of our investments against the Opportunity Zone reporting framework developed by the U.S. Impact Investing Alliance and the Beek Center at Georgetown. And, really trying to get at that measurable impact piece. So next slide, please. And Equity Squared as a firm is positioned in this space, and we're really committed to deploying capital in inclusive and equitable ways, with a true core belief that successful impact investments, achieve this dual purpose, right? So it's both definitions of equity. Next slide, please. So a little bit about our structure, because it's somewhat unique in the space. AltCap owns 99% of Equity Squared, which is the impact investment firm, QOF. It's nested under that. And 1% owned by Community Capital Fund, CCF. So both are based in Kansas City. AltCap really has its roots in the new markets tax credit world. For about 15 years, we've been making those investments. We have a $250 million portfolio there. Have deployed over $20 million in small business lending, essentially turning any of the proceeds we earn off of our new markets portfolio into some pretty innovative small business lending products to continue recycling that in the distressed communities where we're investing and lending. And we're doing all of this with a less than 3% default rate. So no defaults on that new markets portfolio, that less than 3% is on our small business loan portfolio. But all of this really gets at a track record, of investing in distressed communities that are now called opportunity zones. Community Capital Fund, which owns 1% of Equity Squared, is a grant-making organization. So a community development organization that's really focused on neighborhood level grant making. So anything from cleaning up vacant lots to neighborhood carnivals, again, all in that same geographic footprint. And we operate in a bi-state area in Kansas and Missouri. So kind of out of this work, we have that track record with AltCap. We have the access to this really unique deal flow. And then on top of that, we created this fund infrastructure. So those three things, that track record, access to deal flow, and fund infrastructure, are really what put us at this unique kind of crossroads to operate in the opportunity zone and impact investing space concurrently. Next slide, please. So I wanted to share how our fund is structured, because I have only met one other person who's attempting to do something similar, and I like to share these ideas and get feedback and hear from others. So what we're doing, and this is really based on investor interest and what's, how we felt we could appropriately balance the risk, return, and impact over a 10-year horizon. So first and foremost, we believe that small businesses are where we move the needle in our community in terms of, creating access to quality jobs. So when I say access to quality jobs, I mean, jobs for people who rely on public transportation, who don't have advanced degrees or maybe even high school degrees, offers PTO, reliable hours so folks can access childcare, all of these things that are really critical to quality of life and generational wealth building come through investing in operating businesses. And so we look at operating businesses in a couple of ways. Either who we're investing in, right? So someone who maybe clearly doesn't have the bank of family and friends and where our capital can be really transformative, or in an operating business that is very purpose-driven, so social enterprises. Now, before launching this fund and talking to our investment community, there was a lot of hesitation about the 10-year hold. That's still a primary concern. But when you're talking operating businesses, that's real, right? That a piece of land is going to be there in 10 years. And if it's not, then none of us are here and we have different problems. But that land will be here. Operating businesses, even forecasting out 5 years is, still can be quite a challenge. Nobody has a crystal ball. So in order to balance all of this, we have a 50-50 capital split between real estate and operating businesses. Also in our local, kind of in our regional market, businesses raising less than $1 million, really, with check sizes anywhere from 75,000 up to 250,000 is kind of the sweet spot. There's a major gap. And so that's what we set out to fill. And these are established companies. They have a little bit of a track record. They have good cash flows and strong management, but they, again, just don't have the bank of family and friends. Our deal flow being an outgrowth of AltCap's work is, really, so it's really tied to how, we're investing in entrepreneurs of color and women-owned businesses, but it's not something that we are going out and manufacturing. It's just in our DNA, right? So you can see here, 75% of our investments fall into this category. Over 80% of our investments are in folks who have a history with AltCap, right? And often with CCF at the neighborhood level too, personally. So really, this is all an outgrowth of those relationships, which, from a risk mitigation perspective, all the way to being clear on the kind of impact we're having, we feel like this is a really strong strategy. Next slide, please. And this is my last slide here, and I just want to share a little bit about who our investors are and how we've structured our fund. So all of our opportunity zone investors are individuals. And on the institutional level, we had surprisingly quite a bit of interest. I wasn't initially talking to foundations or universities or other entities with, endowments or investment portfolios, some corporations. But what I found, and largely, this is a result of the events of 2020, but not all. Our largest investor came in, separately from that. But renewed calls for racial justice and things like that have companies wanting to do something more than just post something on their Facebook page, right? And so when we're talking about having real impact, let's invest in the communities that need it most. And so we were approached by a few institutions on this front. And really what we found most productive was to form two separate funds that are co-investing in all the same assets. Every asset we're investing in is a qualified opportunity zone business property. But by doing this, we're not limiting ourselves only to capital gains, which really would require us to have just totally different strategy for a fund that could acquire or attract foundations. So in this scenario, we have substantial capital coming from institutions. It's not capital gains, it's not opportunity zone, but individual op zone investors know that their dollars are going to go farther because because we can leverage this other capital. So that's the impact fund plus the OZ impact fund kind of strategy where we're co-investing. Definitely, more of an administrative cost and some burden there. But I think if we're going to have a deep impact and use op zones, to the full extent that they can be used for good and positivity in our communities, then we have to get really creative and figure out ways to make this economical. And so that's what we're doing. And then, the kind of final thing I'll say is that our investors really care first and foremost about measurable impact, right? So they are looking at us because they care about the impact. We have, returns that are, I think, attractive, but we're not competing with your typical, market rate investments. So they have to care about impact, but then they also care about that capital preservation component. And so, yeah, that's kind of their strategy and where they place us. There may be another slide, but we're good. Thank you.
Thanks so much, Emily. And if you don't mind, I just have a few questions, because I remember when the Sunderland Foundation, made their big $1 million announcement, we're supporting this effort. I just think about my roots in the impact investing space and how big of a deal it is to get a foundation to do an impact investment. You know what I mean? To not just think about the grant making side, but to think about how to invest for impact. So can you talk a little bit about the Sunderland Foundation commitment and where that sits within the structure?
Definitely. Yeah, I can talk at length about it. So I'll try to be brief and we can revisit. But essentially, the Sunderland Foundation, it's an entrepreneurial family. They are now in, second, third generation leading the foundation. And the third generation is really interested in doing more than grant making, right? And so we actually were their first program related investment, which I'm pretty proud of. I think that's pretty exciting and says a lot. But basically the way that we approached it was, they were familiar with AltCap. They were familiar with our lending and the work we were doing and already a supporter there. And so when we launched Equity Squared, we had some very candid conversations about what we were trying to do. And essentially, they were very open about this being new and something they hadn't done before, but that they wanted to explore it. And so, first and foremost, it was a lot of open dialogue about how to structure this and any concerns they had, about UBIT or other things like that. But also they're a very nimble organization. And so I had a number of conversations with larger, more established foundations. And even though they, appreciate the intent of what we're doing, they just aren't flexible. Even if they're entrepreneurial focused, they're not flexible organizations. And so it took me a little bit of time to recognize that we needed a more nimble partner. And once I had that conversation with the Sunderland family, it was clear that that's exactly the kind of organization that can do this, right? Because they're willing to kind of think outside the box a bit. And so they structured this as a program. Actually, technically it's a mission related investment, but it's coming out of their portfolio that's just in the S&P and, came out of that and is having a positive impact too, which, yeah.
That's awesome. Congratulations on that. And hopefully that is a model for other local foundations, both in Kansas City, but nationally, around how to invest out of your actual portfolio for impact. That's awesome, Emily.
Yeah, we've facilitated a number of conversations between the Sunderland family and their investment committee with, other individuals with foundations locally who want to get into the space. And I think that those are so rewarding for everyone because they can explore things that they haven't explored before. So yeah, thank you.
Thanks. Well, stick around. More questions during Q&A. And now I'm going to turn it over to David and Will. I think it's actually a really great segue because they are from Hall Venture Partners, and Hall has a very rich history around a family wanting to do good and, with generational expertise. And so I'm going to turn it over to them to talk about what they're doing at Hall Venture Partners out in Provo.
Great. Thanks, Rachel. Thanks, Kenneth. But thank EIG and Aces and Archers for putting this together and having us here today. On behalf of kind of myself and Will Walker and our team at HVP. But to your point, Rachel, we've been at this for about 70 years. So the Hall family really created their early wealth by inventing the man-made diamond, and that started a platform for us to be able to engage with large corporations to either license or sell that technology multiple times. And it was Tracy Hall's vision to create a modern day Edison Labs. And that's really what I had the opportunity of walking into about 2.5 years ago when I joined the firm. I was asked to come and build a growth venture fund. And this was actually before opportunity zones were even being talked about. So I'm proud to say, we kind of call it internally the Anyway Fund, because we were building it anyway. And this is the fund that we built was based around the companies and the impact and the innovation that we've made over those last 70 years, where we now have about 550 people on campus. It's 130 plus acres.
Hey, Dave, I'm sorry to interrupt, but your volume is very low. I don't know if it's me, but
no, I can try to turn that.
I don't know, Rachel, is that coming through or?
You guys just keep doing your thing. Keep going. Yep.
Okay, I just wanted to make sure they could hear him.
Guys.
Now he's muted.
Dave, now you're muted.
You're muted, Dave. Before you were too low.
Well, all right.
Better.
I should be back.
There you go.
All right. So what I was saying is over those last 70 years, we've really focused on innovation and in creating new businesses, patenting early and really creating that moat with patented technology to create businesses. And so when the Opportunity Zone initiative and guidance came along, we really didn't have to change anything to be able to fit what we were doing and the fund that we were building into kind of the guidance that was being issued, which was the exciting part. We were able to continue to move forward and do what we've done. So this campus that's in Provo, Utah, Milken actually just named Provo, Utah, one of the best performing cities in the country. So we were pretty excited to see that come through from the Milken Institute, and happy to be part of building that out. But what we've done after creating the diamond and kind of the vision of Edison Labs is there's about 200 engineers and scientists on campus, and we believe in a shared services model where we provide the services that early stage companies need in order to focus on execution. And in doing that, we've created about an 8.3x return on invested capital over the last 20 plus years, which is the time in which we've been on this campus. Interestingly enough, the land that we are on is brownfield. And it was at the turn of the century, the largest employer within the area, called Ironton. Ironton was a steel mill. So we continue to pull really interesting things out of the ground as we redevelop this area. And but it's exciting for us to reclaim this property and to be able to bring the jobs back to the community that's necessary to continue to innovate and to deliver on some of the premise and the intent behind the Opportunity Zone plan. But as far as the fund itself is concerned, I think Will is probably best suited to talk to this. He's our newest member of the team. Will and I have known each other for over a decade, and he joined us to run business development. But I know when he looked at the firm to join as a member, which I think is probably one of the biggest commitments that you can make, he did a lot of due diligence. And as someone who spent his lifetime in VC and PE, he's got a lot of great insights. And then we can come back and talk about our investor base and kind of some of the ideas that we have for people on approaching family offices, because it's a pretty opaque space, and how to have success doing that.
Great. Thanks, Dave. And thanks, Rachel, and your team for putting this on and inviting us and having us. But, I've been raising money, structuring deals for over 20 years, 25 years, actually. I keep going back the other way so I don't become 108 years old here. But, it's always about who brings you the opportunity or the program, and then also who's attached, who's in it. And, some of the great things that I've learned over the many years of calling on both institutional and high net worth retail investments is to really find some differentiators in the, if not the area, the affiliations. So it's super important to, you know, in Hall's case, that was their affiliation because of all the engineers and scientists that they employ is Brigham Young University, and that area is very fertile. It's one of the top engineering MBA programs in the country. That got my attention, along with the patents, of course, over 1,200 patents issued, introduced. But I would encourage everybody, whether it's Ohio, you know, one of the things the previous speaker hit on that I thought was spot on, familiarity. So when I go to places, whether it's BYU or UCLA or MIT or UMass, it doesn't matter, Arizona State, I look for affiliations, whether it be alumni associations, angel groups. Angel groups thrive. Many of them are local to the area, even if they've moved away, and now they may be running a fund or have capital to deploy in New York, and they may be from, you know, went to Arizona State and be affiliated with a top angel group or a family office. Family offices are no different. They're just kind of on up the road a little bit with what their net worth is. And as long as you pick the specific space, know that they have some appetite in the space, it can be what I call, what I use, you know, really saw right away in Hall, a great door opener because of the patents, the affiliations, the familiarity, and also the success that Hall has had with their multiple exits at, you know, at a high multiple. This can really be not only a great door opener, but it can be a great door keeper opener for your project. And you know, make sure that you're using great affiliations with programs like EIG. You know, that gets a lot of people's attention, and HUD and others that are out there that really support and promote these programs. And we all need the success stories, you know, that, you know, fortunately we're getting on the operating business side, and then, you know, people like Emily and others are getting on the redevelopment side with higher taxes being proposed, capital gains, and then also with the stimulus bills that are getting ready, that are being pushed very, very hard. This is the perfect time to find some affiliations, differentiators for your project, and a good place to start is not only the learning centers, but the affiliations with agencies like EIG and programs that can really connect you and set you apart from just another, you know, another deal. So I'm going to send it back to you, Dave. I hope that was a little bit of insight.
That was great. I just, yeah, I want to be able to flip through a few slides here.
Sure, go ahead.
To just kind of the engaging of the family office universe. So if you can flip through a couple for me here, and I'll tell you where to stop, would be helpful if you want to keep going. So that would be great. We kind of went through some of this without telling you guys to flip through the slides, so I apologize. But yeah, we can. Perfect. We want to stop there is great. So we kind of break down family offices into three categories. It's the traditional family office, it's multifamily offices, and it's angel groups. And you know, the angel groups, I will tell you, have started to become more organized than even some of the multifamily offices that we work with. To the extent where they're putting together their own investment vehicles, they're having their own investor days, their own pitch events, and I've been extremely impressed with the growth within that space. The other thing that I love about dealing with the angel groups is these are typically ex-entrepreneurs. So when you're working with qualified opportunity zone businesses like we are, they know exactly what they're in for. You know, these are venture companies, and fortunately we've had a great track record and success rate of incubating these businesses and exiting those. But it's not without its pivots and its challenges. So having these angel groups and individual investors on board, part of the boards and our investor board, it's been really helpful and exciting to work with them. And then family offices in general, and we can flip the slide here real quick, as I'd mentioned before, are pretty opaque, and none of them are the same. But I had put some questions together and really just some bullet points on things that I'd learned over the last 20 years and approaching and kind of dealing with family offices that I thought I'd share. And the biggest one is just, first, don't blast out your presentation deck, your executive summary. I can pretty much guarantee you that investors aren't sitting at their email waiting for their next unicorn to come through. That getting a warm introduction, whether that's through a wealth manager, friends, family, other business associates or colleagues, as Will had mentioned, really does make a difference. Do your homework on the fund. This isn't a time to experiment. Know that if you're going to spend the time, energy, and effort to get in front of someone, that they actually invest in your space. Pitching your top prospects first. Everyone wants to get out of the gate fast and gets excited about pitching their company and their product or their piece of real estate or whatever it is. What I'll tell you is that don't practice on your best clients. And that's really, every time you do a pitch, you're going to realize that it changes a little bit and you're going to figure it out over time. So although you're identifying those top prospects, don't start with them. As far as asking people to sign NDAs, make sure you're letting them know what they're signing an NDA for. So present to them first, let them get excited about what they're doing. Map out the investor journey, know what these follow-ups look like, build templates, build a process. One of the big things that we've seen at Hall is that building a consistent process over time that is repeatable works. And it works in raising capital as well. And I would just say keeping your deck short, 15 to 20 slides, keeping it simple. I'll leave it on this last one because I know I need to wrap things up here. But early stage investors, whether it's in real estate or operating businesses, I find care about one thing, and it really is the team and who's investing in the deal more than the deal itself. So it is about the people. And so pitch the people associated with the deal, not necessarily don't lead with the product, because I hate to say it, but ideas are a dime a dozen. And it really is about the team's ability to execute, their history of execution, and who the other investors are. And there's always that question that you want to ask yourself of adverse selection, which is why me, why now? So know why you're calling on that investor and why it's a good fit. And Rachel, I'll leave it at that. I know I'm probably a little over on time, so happy to take questions at the end.
Just a little bit, but the insights that you're sharing, especially those last couple slides, I hated to have to, skim through those really quickly because they are really, really valuable. And we're going to have time for Q&A. There's some questions I think that I want to direct towards you guys, but we also will have all of the presenters' email addresses available on the final slide. So I'm just going to say, feel free to reach out to our guests.
Yeah, and I'm happy to go into this in more detail with anyone that wants advice on how to approach different families. And after doing this for 20 years, it's we've created a methodology that we think works and has been successful. So if we can help anyone avoid pitfalls or early failures, then we've done our job. So we're happy to share.
Yeah, and I'll just add this too, Rachel. Remember, everybody's success in capital raising and in formation and execution helps all of us. So, I can talk till I'm blue in the face about my long career and who I know. It really is when I can point to something in a certain space or a certain area, even if it's not my area, but it's in that space, and I can say, look, they just got funded. And look what they're executing on. This is huge. So I'll just leave it at that. I could go into more of it, but
yeah, and I have one more KPI, and that's it. But we've
don't get us started.
We have, through all the technology that's been created on campus, we have created over 3 million jobs. So it is something that we're pretty proud of, and that truly is the last of our presentation. So Stacy, it's you're off and gonna run it. Sorry about that.
No, ecosystems are valuable, relationships are valuable, and rising tides lift all boats. And with that, I know Stacy knows a little something about that. She's done some really amazing work throughout her entire career, but most recently in Riverside as a Fuse Executive Fellow. She was one of the folks who answered the call to help communities with opportunity zones directly. And she's doing really great work with her consulting firm, Blended Impact. So Stacey, I will let you share all of your wisdom and expertise.
Amazing. Thank you so much, Rachel. And thank you for hosting this panel. It's amazing to have a chance to share the work that we're doing. So if you'll go to the next slide, I'll share a bit about what we've done so far. For context, Blended Impact is a venture development firm and innovation lab based here in Southern California, specifically in Riverside, California. We focus specifically on advancing assets into rural and minority communities with an opportunity zone footprint specifically. As Rachel mentioned, I was one of the Fuse Executive Fellows that led an opportunity zone ecosystem, or developing an opportunity zone ecosystem within the economic development departments of our local municipalities. There were 4 selected nationwide, and this is similar to, for example, the Rockefeller COZOs that were also selected nationwide. So for the purpose of today, I'm going to speak more from a working within an economic development field and attracting investors to a region more so than from a fund perspective, though I do have experience on a fund as well. Prior to coming into this role, I was an investor on a late seed stage fund. We did over 30 investments throughout Southern California, and I became particularly interested in opportunity zones because I saw it as an amazing way to invest across asset classes. Spent over a decade also in the real estate field prior to this. So being able to put all of this together for a community purpose and for a community impact, I think is one of the key benefits of opportunity zones, and the ability to use it to attract capital to specific geographies. So if you'll go to the next slide, I'll kind of share what I'm seeing. And I was asked to talk about this from a venture capital perspective. So I'll just kind of set the stage in terms of what I'm seeing so far in the market. We're seeing early stage deals happening right now from companies like Verte Opportunity Zone Fund, for example, the Pearl Fund, Jefferson Capital. They made these investments where you can see 300,000 into startup companies, right? So these are purely business investments that have been made alongside other investments that can potentially cover real estate or some combination of. I do want to point out that it can be early stage or all the way up the food chain. So for example, there are other types of investments that we're seeing where there's a larger real estate play happening and now some space is carved out for community serving retail or incubators, for example. So that's another category that's happening. And the other category is the larger businesses. One of the companies that I'm following right now, for example, is Retail E-commerce Ventures. They have both a venture capital fund or a private equity fund alongside an opportunity zone fund, and they're buying companies out of bankruptcy like Steinmart or Radio Shack, and they're taking it into an e-commerce platform, and they have that opportunity zone fund model alongside them. So when you think about who's investing in opportunity zones and how they're investing into it, it really can be across the ladder from small to large investors. And I'm really excited about these smaller investments because they can be catalytic to an area such as a Riverside or a Southern California, for example. So if you'll go to the next slide, please, I'll talk about how we started it here. I like this framework because this really illustrates well how we thought about it from within the Economic Development Office while I was on staff for that year's period. And the gist of it is how do we identify our assets and communicate it out to investors, and why is Riverside special from a Los Angeles or a Bay Area or et cetera. And I'll kind of go through the process and I'll tell you what we came away from that with. So identifying our assets being the first thing. Second, being identifying where our deal flow is coming from so that we can have a pipeline of deals to showcase to investors once we were to start that outreach or engagement process. 3, doing our own investments into our companies from the ground stage so that investors can recognize that there is some ground level support, whether that's via grants that we co-write with our city partners or nonprofit partners for the benefits of these startups, or whether it be for example, the different business attraction strategies that we're using to attract larger scale businesses to the community that would be serving jobs, et cetera. And then we're also looking at how do we make sure that we have consolidated information across such a large geography? So for example, Riverside County is it contains the third highest amount of opportunity zones in the state of California. That means we're covering 14 cities, and we have key assets like UCR. So all of the proprietary research that comes out of UCR now is key for opportunity zone investments because it sits within an opportunity zone. Not only that, we have emerging classes that are coming about that happens to be very timely with things that are happening in the market. So for example, biotech, ag tech, clean tech. If you've heard anything about the Salton Sea and Lithium Valley, that all happens in Riverside right now. So that means, how do we communicate that out to investors so that they're aware of the activity and catalyze that with our own funds? So for example, one of the first things we did is an ecosystem report with UCR. This was just released last month, where we did a deep dive into who's investing in the region, what companies are here, what exits have we had, what kind of story can we tell about Riverside that would make people excited. So that would be one of the first things I would suggest to folks, is really taking an analysis of what assets, and I think Will spoke to this as well. What's the differentiating factor geography-wise aside from the companies, right? The second thing would be the accelerator and incubator partnerships that we're developing. So the incubators that are in our universities alongside those that might be in private industry, for example, because we want to be able to show that we have deal flow that's active and proprietary to our region. Previously in my company, when I was investing, I would look at anywhere from about 1,200 deals to invest in 15 per year. That's a high threshold to reach. So we want to make sure that even though it doesn't have to be 1,200 deals, we want to make sure that investors can come to our region and see that we have a portfolio of opportunities for them from big to small. And the other thing is the grant strategy that we're pursuing. And I think Emily may have alluded to this as well via their dual strategy approach. We're also doing those same things. So one of the companies we've worked with is a gentleman that wants to start bamboo farming in a desert area of California. We have had USDA support to start that process, and now that's catalytic capital that can potentially be something that can grow into a larger business. We also wrote a grant for an autonomous vehicle company that they control the flow of autonomous vehicles. They integrate in with traffic signals, and we wrote a pretty significant grant to the DOT for them because they had the track record to show that they can manage that. So depending on what is happening in the market, we look to support them in different ways. And that's just a small sample, for example, of what we're doing at the local level. The last thing being local catalytic capital, right? There has been individual outreach that we've had to different types of investors, and I'll go into the typologies a little bit later in the slide. So I'm going to go to the next slide, please. I wanted to put up this framework, and this might help a little bit as well on the venture capital side. So for example, any investor is going to have their own framework. It's not going to be a set questions, like a bank that you're going to think of, but to I believe it was Will's point earlier on, there needs to be some sort of framework that we're all evaluating something by. The framework will change from earlier stages to later. So in the earlier stages, it is going to be heavily on the team. It is going to be heavily on the product and the vision, and can this be executed against? In the later stages, we start getting into more metrics data answers to these same questions. So I'll be asking, what are the key metrics, and what has the growth rate on that been month over month, for example? What's the advisory board looking like that's supporting this? What can be continued, and how can the community, whether it be local government, CBOs or other organizations, support that continued growth so that we make sure that this can succeed in the community. And that goes beyond just the opportunity zone considerations, for example, that needs to be within the fund, but this is the growth of the community as well. So if you'll go to the next slide, I think this is what people are most interested in. This is the question that I get the most anyway. Where to find the investors? And I wanted to put up both a list and a continuum, because at the earlier stages to the later stages, for example, earlier stage companies, it may be in a true continuum where people are moving from competition funding, et cetera, and meeting certain thresholds and then advancing to the next stage, where a later stage company, they may need something stacked all in one capital stack because they're able to bring in or move in a company into an opportunity zone, and really provide some significant impact, all at once, and need that capital infusion. So this might be a good way to look at how the different types of capital plays into each other. It's not just opportunity zone capital in and of itself. Emily mentioned they have an impact fund alongside an opportunity zone fund. And we're also looking at that same model. I just call it the alternative capital bucket, right? How do I infuse companies in my opportunity zones with access to alternative capital that can be catalytic to their business? I also want to make sure that people know some really grassroots or ground up type of ways to identify the investors, and then use the tips that were just mentioned in terms of how to reach out to them. The thought process behind this is existing business communities. For example, we have a number of businesses that they have exited, or they have annual opportunity zone or gains that they may be interested in investing right back into the community. Community investors are the ones that I'm most excited about, and the ones that I'm having the most flexible conversations with, because they want to see things happening in their community and growing, and do it as a way to not only give back, but be hands-on with that company. Different directories, different banks, CDFIs, there's a number of ways, and I can go into any of these more with anyone offhand or offline, because I want to make sure that folks know where the access is to capital, and how we approach it from a local level, and what we're doing next to try to streamline this. So when they were talking about tools and frameworks, for example, one of the things we're looking at and building out is an actual alternative capital accelerator to be able to take our companies through a process of layering in these capitals or capital stack into their mix, to be able to then seek additional capital, and also a way to evaluate or capture the data as well early on. So just wanted to leave you all with that, and I'm happy to turn it back over to Rachel.
No, that's so great, Stacey. And I'd imagine there are a number of folks who are taking a screenshot of this slide in particular. So we have about 3 minutes, always right up to the line with these webinars, but a lot of questions. I've been kind of assigning some questions in the background here. So hopefully, for the panelists, feel free to directly answer some of these questions, but Kenny, feel free to also pop back in. I think I can take the first one here, which I'm going to direct to Emily, but would also encourage everyone to participate in answering this. So this question is, are all of your investors accredited? So number one. Number two, did you have a minimum investment? And then number three, what percentage of your portfolio is OZ driven versus broader impact driven? So driven by impact versus driven by the opportunity zone benefit.
Yeah, so we are actually limited to accredited investors. Sorry, I have a newborn. Sorry, Rachel, repeat number two there.
Nope, we were kind of joking that we would have like a fifth panelist. So Emily, thank you for being a mom and pulling double duty right now. Yeah, so accredited, sorry, Emily, accredited, minimum investment. We know that Ohio, we saw investments of 25K. That's typically what I'm seeing as far as a minimum. Is that what you took?
Yeah, so our minimum is actually 100,000. And, we've accepted as low as 40, but most of our investors come in at least that 100,000 level. Okay. Yeah.
And I'll just open it up to other folks just around minimums, investment minimums, as well as accredited versus sort of like what you may call unaccredited or like retail. Folks talk about it in different ways.
So part of the structure, Rachel, in investing in opportunity zones is it has to be done through a fund.
You're low again, Dave. Sorry. And I can't get my camera back on, Rachel. The host has to allow me to do it.
What I was saying is that investments need to be done through a fund. And in order to be qualified to invest through a fund, you have to be an accredited investor. So we too are restricted by having accredited investors invest through our fund vehicle and participate in the opportunity zone.
So I will say there are some ways if you blue sky.
There are.
Yeah, so
Yep.
you can blue sky. It just depends on your fund offering, but it sounds like your fund specifically is accredited investors.
Correct. And yeah, it's, as far as the offering goes, makes a difference too, on what you qualify for, in terms of, under, regulation D, which is the exemption.
That's right. Exactly. Yep. Awesome. Thanks, Dave.
Yep.
Okay. We are bumping up right at 3 o'clock. If panelists can hang on for just like one more moment, maybe we could do another question and then call it a day, and you guys can reach out to them directly if need be. Let's see. I should have had something lined up. Kenny,
I've got something, yeah.
Go for it.
So a question to Stacy, if she has a template for rural assessment. And we also have a question, if anyone can elaborate on blue sky. So Stacy, do you have a template for rural
I
assessment?
do actually having a template for that and happy to share. So feel free to email me. It's Stacy at Blended Impact, and I'm happy to share that out as well, because that'll cover not only how to think about the actual company, but the geography in addition to opportunity zone qualification points. So Stacy at Blended Impact, and happy to share.
That's awesome, Stacey. Can you put that email address in the chat so folks have it? Because we have the Opportunity Riverside email on screen. So yeah, thank you. And Blue Sky. So shorthand for when you have to register in every state, because if you want to sell to when you want to solicit from investors that aren't accredited investors, then every state is going to have a different rule about how you solicit or how you sell your offering to those investors. And so you're going to have to register and get that approval. It's an annual registration. And that is just offhand referred to Blue Sky. Hopefully that helps.
And I saw one more question in the chat about if anyone is working with historically Black colleges. Also happy to speak there. There is an investor that I'm working with that's actually trying to roll something out. I believe it's in Atlanta, and we have a call scheduled for next week. So Keith, if you also want to email me, happy to speak there.
Yeah, and to that end, we know that there is the great project at Stillman College in Alabama. We've been in contact with a number of membership associations representing minority serving institutions, MSIs, and HBCUs. So continuing to try to build up the capacity and knowledge sharing and ecosystem within those networks, because they can be such a powerful driver of leveraging both the physical asset of real estate, but also the social network and activating investors within their alumni networks and bringing about positive benefits to their students and their campus.
Fantastic. Well, I think that is a good note to end on. So with that, a big thank you to our panelists, and a big thanks to Rachel for helping to guide the discussion. And of course, thank you to all the viewers for tuning in today. And we look forward to seeing you next time. And again, we're going to be circulating these slides and the recording to you all after this webinar is concluded. So big thanks and have a great afternoon.